Good morning, clients and trading reps, Remisius. Welcome to today's morning call. I'm Joshua, the head of research. Okay, we'll start straight away. Our usual disclaimer, and we'll give a little bit of an update on the macro and market outlook. Okay, macro indicators actually still suggest that global growth is, on the whole, still in an expansion phase. The US is modestly solid. Eurozone's coming off a low base. Japan's in expansion, and China is slowing, but actually still in expansion. ASEAN ex-Thailand looks more positive, especially with Indonesia's current account improvement. Basically, the macro outlook in many of the countries that matter to us is actually looking quite okay, except for Thailand, which has an impasse due to political situation. Now, in the market analyses, we have still a long-term bear trend for bonds despite this year's outperformance. And the yield curve is still very steep, and sector rotation still suggests that things like industrials are leading, and all these still suggest that the bull market is actually still on, albeit it looks like 2014 is a consolidation year, especially for the S&P 500, which Kenneth has already guided about a month back that we are likely to go sideways till mid-year, and if we do have a correction, it'll be less than 20%. Such a subdued outlook in the US is likely to weigh on the STI, but we view that the STI has more upside than downside risks, as unlike the S&P 500, it has not had an outperformance 2013 year. It has remained rather flat, actually, and valuations on the STI are still rather cheap. So it's a not here, not there market, which means we stick to our stock picking strategy, which we have had since the 10th of February. Just to reiterate, we have also added a couple of picks in here. We have not taken away any. Bastard, First Resources, M1 and Silver Lake are on the list. We've included Pan United, and Iconics is still on the US top pick list. And we have also included Outer Wall. So let me start with Bastard. Its market cap is close to $1 billion. The industrial property portfolio is valued at 419 mil. Net cash is about 200 mil, which means the core business of energy, industrial design and build, geospatial, are actually valued at 9.4 times this year's earnings, this FY earnings, which is ending in March, and 7 times the next FY earnings. It has performed very well so far this year with 13.6% return year to date. First Resources is a young plantation, and that will continue to drive strong production growth. It's got best-in-class operational efficiency, and the CPO price used is a flat one. We're expecting 11.5% earnings growth, and it has performed close to 10% return year to date. Pan United, we've just included today. It's the largest supplier of ready-mix concrete and cement in Singapore, and it's the perfect proxy to the infrastructure boom. And its port in that serves the Suzhou, Wuxi, Changshu region is actually in a duopoly situation, which bodes very well. The port has also expanded capacity by about 60% by acquiring its neighbor, and we're pretty confident that capacity will be filled as the original port is already running at 90% capacity. So if you add in the new capacity and basically it'll turn more profitable in about 2 years. Actually, it's trading at 8.1 times FY16 earnings. The stock has returned 2.6% year to date. Now, M1 is a straightforward story of data monetization of tiered plans and doubling the access usage charges and growing fiber broadband from a low base. It has returned 3.1% year to date. Silver Lake Axis has 40% of the largest ASEAN banks running their core banking systems, recurring income with each new contract, and we do expect new contract wins with 20% earnings growth this year. It has performed so far slightly flat to negative at minus 1.1% year to date. But I do believe that these 5 picks here have outperformed the STI so far, which has, I think, returned about a negative over 2% year to date. Our US stock strategy is picking the Iconics brands, which has 100% revenue from brand licensing royalties, which means there's negligible capex and no working capital. Free cash flow margin is about 50%. It aggressively buys back shares. It owns 31 brands. The revenue from overseas is now 37%, and watch out for overseas expansion, basically. And it recently consolidated its LATAM JV to 100%. So it's priced at 13 times free cash flow, has returned about 1% year to date. Outer Wall owns Coinstar, which is a coin counting kiosk, and Redbox, which is a DVD rental. And these have monopolized their markets with no comparable competitors and generate a lot of free cash flow that have been used to repurchase 36% of outstanding shares since 2011. This is a contrarian call because I think most people will be focused on whether Netflix will have an impact on the DVD rental kiosk business. But as Yong Kai has reiterated in his extensive presentation, I think last week, there is still plenty of cash flow to be got from Redbox, and it has a pretty dominant market position in the US. And actually, Netflix has been encountering streaming issues. So Redbox DVD rental kiosk has actually increased market share and grown revenue by 155% since 2009, which is quite impressive despite technological improvements. So 7 times price to free cash flow has returned slightly negative at 0.8% year to date so far. But we believe that these picks will outperform for the year. And basically, we're telling people to not worry too much about the market. In fact, forget the market, just pick stocks. Although we may not have a full-on bull market, the fact that many of these mid-caps can rally is testament that this is not a dead bull market. Okay? I'll move you on to Ben, who will give you an update on DBS's acquisition.
Good morning, everybody. Benjamin here. So last week, if you've been following the news, DBS announced on Monday the acquisition of SocGen's Asia Pac private banking arm. So they paid Sing dollars 279 million for this acquisition. So in essence, what they bought was 16B Sing dollars of AUM from SocGen's Asia Pac private banking arm. So what they actually paid was about 1.75% of the AUM value. So what they're going to get from this acquisition is that the AUM total amount is expected to increase 15%, 125B. Alright, and high net worth AUM will increase by 23%. Alright, so where does this place them in the table? So second in line in terms of AUM ranking, is OCBC, which comes at about 46 billion when they last reported at their FY13 year end. Right, so the total AUM that DBS is managing, will be about 2.7 times that of OCBC. So again, DBS was already the market leader for private wealth management, right? And this places them way ahead, and is again in line with their strategy. So for the acquisition wise, it's relatively small, be funded internally by cash, and it's not expected to have any impact on their net capital position or their book value. Right, so what we think is quite competitively priced, and it should have not much of an impact on DBS. But overall, we like DBS for their very disciplined approach in terms of any inorganic growth strategy, which it's been proven that if the deal that they're pursuing is not favorable in terms of pricing or whatsoever, like the Bank of Danamon, alright, they'll usually abandon it. So this is quite a disciplined approach that we like. So in the long run, we expect this to gradually lift the earnings. So some of the key things that I would like to highlight, from this acquisition is that, first of all, let's look at the pricing wise. So the purchase of SocGen's AUM is AUM, which means it's assets under management, okay, which is the assets you manage for your clients. Okay, it's pretty competitively priced at 1.75%. Okay, when we look back on a relative comparison, we look at OCBC when they paid for ING in 2010, they paid about 9.3%, which is substantially much higher than what DBS is paying currently. All right, but of course, if you compare like to like, SocGen is way smaller than ING, right? And it's not something that's very transformational for DBS, which is a complement to their strategy. Whereas if compared to OCBC, they paid their premium, right? Because their AUM actually tripled after they bought over ING private banking. Okay, it's something very transformational for OCBC. That's why it fetched such a high price tag in comparison to DBS currently. Okay, so secondly, what does this acquisition mean to them? Okay, DBS, I did mention before quite a few times, right, that the banks, especially DBS, is going along the approach, right, of cross-selling between different business lines, right, between their wealth management as well as their commercial and corporate banks, okay, and cross-selling all the treasury products across these two segments. All right, so when growing the AUM base is not too difficult, but acquiring new customers, new client base is difficult. So that's why with this acquisition, it gives DBS access to new high net worth clients as well as experienced relationship managers. All right, and according to a study by McKinsey, right, if you look at the high net worth as well as the ultra high net worth client profile in Asia, okay, most of these rich people, high net worth people, right, are usually of first generation, which means that they are very savvy businessmen, entrepreneurs, right? So when we offer wealth management services, right, these people are not looking just for private wealth management services, right? They look to the banks to be able to, a big enough bank that's scalable to help them to manage not only their own private assets, but also business advisory, right, business banking, as well as managing their family's assets as well, right? So again, this acquisition is a complement to what DBS is pursuing along this line. Okay, so lastly, about the EPS accretion, okay, management expects this acquisition to be EPS accretive in about a year's time after this one is completed at the end of 2014. Based on our scenario analysis, with the increase in 16B of AUM, but we expect this not to have much of an impact on the bottom line. Right, so based on the assumptions that we have in 2015, we expect this acquisition to lift earnings by only about 0.5%. Right, so there's quite a minimal impact. Right, so again, it's more of a long-term fit. Okay, so overall, our target price is still maintained at $18.48, right, and still accumulate rating. Right, so I hand over now to Nicholas to talk about commodities.
Good morning, guys. With regards to our commodity sector, we issued a report on our commodity sector last Friday. As you can see on the diagram on the right, recently commodity price has rallied up to a one-year high of $890 USD per metric ton due to three main factors in our view. First is the CPO demand from Indonesia's biodiesel mandate. Second is the dry weather risk, which may impact CPO production going forward, as well as third, the low Malaysia inventory level, which has been below the 2 million tons level for more than 6 months. Going forward, there are upsides and support for CPO pricing. The first upside for CPO price is the weather risk. According to Australia's Bureau Meteorology report, it states that the most climate models shows that the temperature is approaching and exceeding an El Nino event is pretty high. The weather risk, if the weather risk materializes, CPO production is likely to be negatively impacted. This could lead to a tighter supply of CPO going forward, and not forgetting the fact that El Nino impact has a lag effect over 2 years. So this may affect production going forward over the next 2 years if the El Nino event really materialize, hence providing significant upside to CPO pricing. The support, there are two main factors that support current CPO pricing. First is the biodiesel mandate. While there are concerns on the unfavorable economics of biodiesel blending in Indonesia, especially when the CPO price goes up, due to the fact that Indonesia government will have to come up with more subsidies if the CPO price goes up. But having said that, Pertamini has already procured 2.4 million kiloliters of pump-based biodiesel. This represents 45% of its total 5.3 million kiloliters target for 2014 to 15 over the next 2 years. And this is also equivalent to about 9% of Indonesia's annual CPO production. Second point is the low inventory level. We see good support in CPO pricing at $750 per metric ton from the low palm oil stock level in Malaysia itself, which has stayed below 2 million tons level for 11 consecutive months. But having said that, we shouldn't forget that there are also downsides for CPO pricing. First is the rising global vegetable oil supply. Based on the USDA projections, we estimate that the stock usage ratio for the global vegetable oils will increase to 12.3% in 2013-2014 marketing year from 11.4% in 2012-2013. This rise in global vegetable oil supply could put downward pressure in CPO price. Second is the soybean oil. Currently, the CPO to soybean price discount is about $76 per metric ton. This is much narrower in terms of a discount as compared to its 5-year historical average of close to $200 per metric ton. This indicates that the CPO now is less attractive relative to soybean oil. Thus, we may see shifting of demand from CPO to soybean oil going forward. Third is the CPO production recovery. Barring the fact that if we don't look at the recent weather risk and not taking into consideration that, we should see CPO production to recover from its biological downtrend which they experienced last year. And if, let's say, the production recovery really materialize, we should see stronger supply fundamentals going forward in 2014 and 2015. This will result in a higher supply, hence putting downward pressure on CPO pricing going forward. Should you need to know more about the further studies on the CPO pricing, please refer to our report, which was published last Friday. Now, I'll hand the mic over to Colin, who will talk more about his initiation on Del Monte. Thank you.
Hi, morning everyone. Today I'll be sharing more about Del Monte Pacific, which we have initiated coverage on 20th March. Okay, this a quick snapshot of the company. Share price last Friday was trading at about 62 cents, and the market cap is about $630 million, and adjusting for the post-acquisition, taking into consideration the dilution effects, the share price is trading at about 16 times of the forward P for FY14. Okay, so just to share about the company background, Del Monte Pacific is a leading producer and distributor of quality branded food and beverage products, and is listed on SGX and the Philippine Stock Exchange. Okay, it has rights to the Del Monte brand, excluding fresh produce, in the US, South America, Philippines, the Indian subcontinent, and Myanmar. Yes, also global rights to the S&W brands, excluding Australia and New Zealand. Do take note that Del Monte Pacific is not affiliated with other Del Monte companies worldwide. This company also operates one of the world's largest fully integrated pineapple operations with a 23,000 hectare plantation as a cannery with 700,000 ton processing ton capacity, as well as an integrated seaport located in the southern Philippine islands. It mainly operates in two business segments, which is the branded and the non-branded segment, where branded sales takes up about 70% of the total revenue. Also has a 50-50 joint venture with Bati to sell these Del Monte branded products in India, and also to export fresh produce and vegetables under the Feel Fresh brand. Recently, it has acquired Del Monte Foods in the US on February 2014, and this allows it to transform into a global food and beverage company with a 5 times increase in sales. So on the mainly the growth in Del Monte Pacific is strongly supported by the strong domestic growth in the Philippines. It sells mainly processed products, including processed pineapples, tropical mixed fruit, as well as juice, beverage, and culinary products in the domestic markets. Okay, Philippine sales contributes about 85% of its branded sales, which implies that's close to 60% of its total revenue. And it has a strong growth at about 6.7% compounded annual growth rate over the last 3 years, and it has a operating margin of about 12% based on the 3 years average. Some of the competitive advantages that Del Monte Pacific has is that it has dominant market shares in the Philippines that's supported by a strong household brand in the Del Monte trademark with a 88-year history. If you can see the diagram on the right of the slide, you'll see the market shares that it has for the various product categories. Okay. Also, Del Monte Pacific has a wide distribution network with 16 distributors nationwide, and it also sells directly to supermarket, fast food chains, as a restaurant, etc. Also, with its fully integrated pineapple operation, as it mainly grows and processes its pineapples, is able to have a cost efficiency from benefiting from cost efficiency for its fully integrated operations. Also, it has sustained marketing efforts, and that will help to drive sales of its product as it promotes health benefits of its pineapple and tomato-based products. One example is its Kitchenomics program initiative, which is launched since 1984. It is mainly to help generate loyal consumption of the Del Monte branded products. Okay, so this program mainly includes a cooking show, cookbooks, as well as offering free recipes that can be found on its website. Okay. On the S&W, which Del Monte Pacific has acquired this brand name in 2007. Okay, the S&W allows the company to market its fresh produce and packaged products in Asia that's outside the Philippines, Indian subcontinent, and Myanmar, which it doesn't own the rights to the Del Monte brand. This Del Monte the rights to the Del Monte trademark in Asia is mainly owned by the Kikkoman Corporation in Japan. So the sales from S&W segment enjoys a very strong growth, growing more than 4 times from $8 million US million dollars in FY08 to about $40 million US dollar in FY13. Under this segment, it mainly sells fresh and processed products in Asia as well as the Middle East. So on the S&W process, it mainly sells canned fruits, vegetables, tomatoes, beans, and juices. And its key markets are mainly in China and South Korea, which contributes about 40% of its processed sales. The company expects a higher growth to come from North Asia, which is mainly China, Japan, and South Korea, which are also the 3 biggest importing market for pineapples in Asia, as well as a higher growth to come from the Middle East region. And also one of the growth driver, it will be a product mix shift to canned ready-to-drink juices from concentrates. Basically, the canned branded ready-to-drink juices has a higher profit margin as compared to juice concentrate. And also, with also new product launch such as fruits in carts will also help to drive sales. On the S&W Fresh segment, under this segment, the company mainly exports fresh pineapples. Key markets are similarly in China and South Korea as well, which contributes about 55% of the S&W fresh sales. For this segment, it faces less competition and also enjoys a much higher operating margin of more than 18% based on 3 years average. Its lead product under the S&W Fresh is Sweet 16 pineapple. This is of the MD2 variety. Compared to other varieties of pineapple, this variety tends to be sweeter and also has a longer shelf life of about a week. Okay, so on to the acquisition of the Del Monte Foods in the US. They acquired the US food business for close to $1.7 billion US, and this grants access to the packaged food and vegetable market in the US, as well as a potential $50 billion beverage market in the US as well. Del Monte Foods in the US owns a portfolio of premium brands which comprises of Del Monte, S&W, Contadina, and College Inn. The food business also enjoys leading market shares for the processed foods and vegetable categories, as well as the number 2 position for canned tomatoes and broth. The table on the right where shows you the market shares that it has in the various categories. Some of the growth opportunities that will come from the acquisition will mainly includes will come from the canned pineapple and new product segments, which example culinary and beverages. Okay, the management is positive that it's able to increase penetration, especially in the canned pineapple segment, as currently the US Del Monte Food is having a market share of less than 10% in the canned pineapple segment. To note that for the processed fruits, pineapple is in fact one of the most popular fruits in the US. Also, other growth opportunities will come from synergies from this vertical integration that stands to benefit from access to the processed pineapple segment in the US. Effective cost management that will mainly come from reduction of overhead expenses as well as optimization of underutilized production facilities in the US, and also is able to tap on to the South America markets, so that's a very big growth potential that may come from that region in the long term. With the acquisition, the Del Monte the company's sales will grow about 5 times. However, Del Monte Foods net profit is only about twice of the current group entity. That's mainly due to a lower operating margin in the US due to tighter competition as well as higher taxes as well. The funding for the acquisition will mainly come from a combination of debt as well as equity financing, which will mainly comprise of the rights issue as well as preference shares. To take note that the company will also align its financial year reporting with the US business. So for the next coming financial year reporting, it will be shifting its financial year end from December to April to align with the FY reporting of the US food business. So to sum up on its investment merits, Del Monte Pacific is having strong equity brands which allows premium pricing against its competitors. Also has leading market shares mainly in the Philippines and the US, and that will allow it further consolidation as well as growth globally. Also, the investment merit is coming from it has been a globally competitive pineapple producer, which allows it to produce high quality pineapples at low cost due to its fully integrated pineapple operations. It also boasts an experienced management team whereby each executive officer has more than at least 20 years in the consumer goods industry. So the key competitive advantages that Del Monte Pacific has is mainly its premium brand with more than 100 years of history, its fully integrated operations, as well as a global market presence. Key growth drivers will mainly come from the shift in juice product mix, mainly from concentrates to the more profitable branded ready-to-drink juices. And also is positive on the growth that will come mainly from the Philippines, North Asia, as well as the Middle East, as well as growth that will come from the expansion of the acquired business in the US. Some of the long-term growth drivers also includes the Indian joint venture, which I expect to be profitable from FY17 onwards. Right now is currently operating at a loss due to the high operating expenses as it seeks to penetrate the food and beverage industry in India. Also, Del Monte Pacific currently has 3 long-term supply agreements with other Del Monte companies, which comprises of Fresh Del Monte Foods in the US, as well as Del Monte Asia. Right now, only the supply agreement with Del Monte Asia is the only one that's profitable. So we expect the supply agreement with Fresh Del Monte, it will be shift to market pricing beginning FY15, and that will also allow it to have a potential upside of at least $3 million US $3 million in operating profit. So also it will have a long-term growth potential that will be coming from the South America venture. Okay, so just a quick overview on its financials. Okay, the figure on the first left, you see the comparison between its branded and the non-branded sales, as its branded segments mainly has a much higher gross margins due to its premium pricing. Okay, as well as the operating profits that's contributed by the branded and the non-branded segment. Okay, do take note particularly in FY09, there was some severe supply issues, which management has already resolved it since then. So that actually led to a lower revenue in FY09, which impacted FY09, FY10. So otherwise, adjusting for that, you should be able to generate regular operating cash flow about 30 to 40 mil, okay, year on year. And also earnings per share, if you look at the figure, the middle figure on the right column, right, we adjust for the earnings, as in FY13 it incurred very high one-time expenses that's relating to the US acquisitions. Otherwise, you'll see that the recurring net profit will be higher year on year for FY13 onwards. Do take note that it has a regular dividend payout of 75%, but we due to the acquisition and the heavy financing, we expect it to be lower going forward. However, its current dividend policy dictates a minimum payout of about 33%. Right, so just a quick overview of how it's going to finance the US business acquisition. Is mainly it takes up a debt financing at the acquired US company of about $970 million. So this the loans will comprise about 7 to 8 years syndicated loans, and so they will due to the debt financing that's taken in the US business, they will enjoy a higher tax saving as well, as US taxation is higher at about 30%. Also, there will be a minority stake in the acquired companies by the third-party investors. So there was it's estimated to have about 10% non-controlling interest. At the current group entity level, it will also takes up a combination of credit facilities as well as bridge loan facilities. For the bridge loan facilities, it will mainly be replaced by the rights offering as well as preference shares in about 4 to 6 months time. Okay. So adjusting for the post-acquisition effects, mainly taking into account the possible dilutions from the additional equity as well as the preference shares, we estimate the net gearing to increase about 1.5 times after all these preference shares issuance as well as the rights offering. So adjusting for the combined entity, okay, right now the price is trading at about FY13 P of about 18 times, and the forward P will be about 16 times. For more details, please refer to our initiation report that was uploaded on the 20th March. Right, so to conclude, mainly we are positive on growth that will be coming from the emerging markets in Asia, and also the Del Monte Pacific have excellent growth potential in the US as well as the South America region, although that will probably be realized over the long term. Some of the key risks to consider with relating to the acquisition will include the execution risk, competition, as well as the financial interest rate risk that's coming from the financing. However, we believe that the company is in a good position to well manage the risk. Just to touch on more on the risk, on the execution risk, Del Monte Pacific already has some existing working relations with US Del Monte Foods. That's due to the existing supply agreement, so that will actually help. Also, to add on, Del Monte Pacific will also retain key management with the US business, so that will help mitigate the execution risk to a certain extent. On the competition risk, although the food and beverage industry has several other competitors that's able to provide other quality food and beverage products, but we believe that Del Monte Pacific has core competencies in pineapple and other tropical fruits, so you will be able to increase penetration in relating to those processed fruit segment. On the financial interest rate risk, management has shared that you will be exploring interest rate swaps that will help to manage the interest rate risk, and going forward you will have a prudent dividend payout as well as a prudent cash flow management to manage the indebtedness risk. So based on the current valuations, we believe that there's potential upside of at least about 30% based on our target price of 82 cents for Del Monte Pacific shares, and we're having a buy recommendation. So the target price is about 21 times of the FY14 forecast earnings per share, and that's that's close to the global peers average, and that's also adjusting for the dilution effects as well. Right. So right now we come to the Q&A questions. Do post your questions. Right, there's a question on mainly how many Del Monte companies worldwide. Actually, there are several Del Monte companies. I think the known one mainly comprises of Fresh Del Monte, which has rights to all the Del Monte trademark for all fresh produce globally. There's also Del Monte Asia, which owns the Del Monte rights in the Asian region, excluding Philippines, the Indian subcontinent, as well as the Myanmar. There are also several other Del Monte companies. For more details, you can actually refer to the company's website, where they actually list the list of other Del Monte companies. The areas that's covered under Del Monte and S&W by Del Monte Pacific, just to bring you to the first or the earliest slides. Mainly it has rights to the Del Monte brand in the US, South America, Philippines, Indian subcontinent, and Myanmar. For S&W brand name, it has global rights, but that's excluding Australia and New Zealand. That's mainly owned by Menachem Foods Company. Relationship with S&W, it actually acquired the brand, the right to use the brand name since 2007. So it's Del Monte Pacific has the rights to market its products under S&W brand name in Asia and Middle East. And now with the acquisition of Del Monte Foods, the US is also has the rights to market its product under S&W brand in the US as well. Question on whether the latest typhoon affect Del Monte. Do not no. This is because the plantation of Del Monte is mainly operates in Mindanao, which is the southern Philippines, and that's actually situated from the typhoon belt. The typhoon mainly over the past years has affected mainly the northern and the central part of the Philippines.
Hi, there's a question on Keppel Corp and Wilmar. For Keppel Corp, our house views still remains the same. We have a accumulated rating for Keppel Corp. Current headwinds which we are seeing right now is that oil companies are cutting their E&P spending. But having said that, there are still E&P capex growth as compared to 2013 last year. So we will still be seeing capex growth, but not as high as previous year. So going forward, we are also seeing Keppel Corp coming with new product mix like the drill ship, as well as the FLNG. So they are coming up with new ways to keep themselves competitive in the market itself. Also, not forgetting they have globalized yards in 20 countries. So this also gives them a comparative advantage over its Chinese peers. As for Wilmar, we continue to see growth and recovery in its oilseed and greens business division. We expect this division to remain strong going forward as China continues to absorb more capacity for its crushing industry. Palm and lauric division remains robust as Wilmar moves down to its high value-added products like oleochemical and biodiesel. This should sustain its margins going forward, despite the increase in capacity over in Indonesia itself. So we also like Wilmar's integrated business model, where it has business from upstream all the way to downstream business. This should allow them to maximize all the efficiency and take profits at every stage of the business process. We have an accumulated rating for Wilmar and Keppel Corp. Our target price for Wilmar is 388. Thank you.
Hi, right, there's a question on whether Del Monte has any business relationship with Monsanto. We are not aware of whether it has any working relationship with that company. Okay. Another question is more color on the majority shareholders of the company and whether there's any political reason. Del Monte Pacific is majority is owned by NutriAsia. This is a food is a conglomerate in the Philippines that mainly deals in the condiments and sauces. Is mainly 70% owned by NutriAsia. Also another about 7% that's owned by the some pineapple company. So the public float is close about 25%. Whether there's any political risk, we do not really see much political risk in this aspect. In fact, recently there was an announcement by the Philippine government that it will be signing a peace treaty with some of the major Muslim separatist group that's mainly situated in the southern Philippines. So there will that's also quite we see quite implies a good good benefit for the Philippine operation in Mindanao. On the question on whether Del Monte is operating on bank loans for cash flow, Del Monte they usually undertakes loan. Right now is undertaking credit facilities. That is mainly based mainly on the short-term loans. That's renewable with every 6 months. So, however, due to the financing for the acquisition is you has a you see a significant increase in this net gearing. For more details, you can refer to our initiation report, which has quite detailed information on the financing and how the acquisition will impact on this earnings and finances.
Hi, there's a question on CPO price and golden agri. Yes, there is direct impact on the CPO price on the golden agri itself. In fact, if you take a look, golden agri's price has reached almost 1 year high of 60 cents due to the recent rally in CPO price. But having said that, we still prefer First Resources given the fact that the First Resources is still our top pick in terms of if you want to have more exposure to the upside in CPO price, as First Resources is more leveraged to CPO price. In fact, coupled with the First Resources year-on-year growth in terms of CPO production, this should drive up its share price more when the CPO price rally itself. Our rating for First Resources is accumulate with a target price of 553.
Yep. Hi, this is Lucas here. I'll be addressing the question on what's the outlook for CapitaLand and CapitaLand, and obviously I think that City Development goes in together with these two developers without saying. As per previously, I have already kind of like preached the fact that these three companies is really at the bottom of their valuation at about 1-2 weeks ago. They're already hitting the bottom of their valuations. So we are definitely having a favorable outlook for these three companies based on numbers alone. But that's why we say the murky outlook for the policy will always be something that is kind of like an overhang. There will be a lot of policy implementation, fine-tuning. But the most recent policy, with regards to the policy, is that the government is starting to say that, well, they are happy where they are right now. So they do not foresee any heavier corrections to heavier policy implementation residential policy implementation going forward. So having said that, the outlook for CapitaLand and CapitaLand is definitely positive, and that goes the same for City Development. Yep.
Hi, so I have a question on Outer Wall about whether the hedge fund selling a huge stake after pressuring the management to do the reverse tender. Yeah, this we are aware, and we actually noted this in the report because they reduced the stake from roughly 13% to 8%. So that was the 8% was the stake that we reported in our recently published reports recommending about the purchase of Outer Wall. Yeah, I mean, that being said, we understand that Jenna made some money off it, and they actually sold less than 50% of this stake before the tender. As of right now, we haven't seen any signs saying that they tendered the rest of it into this offer already. Yeah. So if there's anything else that we know, we'll be update. But yes, thanks for informing, and we have actually noted that. Thanks.
A question here on Pan United. What is the outlook of Pan United that it will clinch T4, T5 and Jewel project? It's already in T4, supplier there already. T4 and T5, I have not heard from the management yet, but I expect that it would probably be involved. In fact, I have not seen a major project in Singapore where it has not been involved. As controlling 30% of the market share, it's quite likely to be involved in any large project in Singapore.
Hi. Question on whether Del Monte Pacific is listed in the US or other regions. No, it's not listed in the US. This company is listed in both Singapore and the Philippines.
And there's a question on the CPO price and palm-related companies. There is definitely a direct impact in terms of CPO price and the profitability of palm oil-related companies, especially if palm oil-related companies has a huge focus in our upstream plantation business. Companies like Wilmar, Golden Agri, and First Resources, definitely the earnings are impacted by CPO pricing. Having said that, for Wilmar, it is the least sensitive to its profitability is least sensitive to CPO pricing due to the fact that it has other downstream business and midstream business like palm and laurix, oilseed and grains, as well as their sugar division, which actually in fact diversify away its sensitivity of CPO pricing. For Golden Agri, it used to be one of the highest. It used to have one of the highest sensitivity in terms of CPO pricing to its profitability. But as Golden Agri slowly moves down the value chain to focus more on its midstream and downstream business, going forward, we see that sensitivity of CPO pricing to Golden Agri's profit will decline over the next few years. As for investors who are more keen to be exposed to any upside in terms of CPO pricing, it will definitely be a good choice for investors to shift their money over to First Resources, given the fact that First Resources is one of the purest play in terms of CPO pricing, due to the fact that most of its, in fact, more than 90% of its revenue comes from CPO plantation business itself. Hope I answer your question.
Hi. Question on competitors to Pan United for its for cement, I presume, and ready-mix concrete. Okay, so we have, the big players are all here: Lafarge, Cimex, YTL. However, they do not command as large a market share as Pan United. I think in the spread of competitors, there are about 8 or 9 RMC players in Singapore, but Pan United owns the largest at 30%, and the second largest is about 15%. That management has informed us. Are there any more questions?
There's a question on, given your confidence in SG infrastructure, do you reckon Tat Hong will turn around soon? Okay, notwithstanding its Aussie exposure, I think, but that's the key. So the thing is, if you are talking about confidence in SG infrastructure, Sin Heng will be a much better proxy because Sin Heng takes in about, I think, 70% of their revenues, or their net profit is actually in SG Singapore itself, whereas the percentage for Tat Hong is not so high. We don't cover Tat Hong, but I do know that they have a significant portion of their income coming from Australia. Yeah, so based on SG confidence, right, Sin Heng is actually a better proxy.
Hi, we have a question here on MTech recent pricing. Yeah, MTech is a company that we're closely tracking, and we view that the recent run-up in the share price is because of its US acquisition, which basically transforms MTech into a manufacturing company which has operations in just about every continent on the planet. Now that is significant because we know that MTech heavily supplies the auto industry, and from our experience of other manufacturers, once you have a parts that get rejected, it can be quite a heavy cost to the company, because if, let's say, you're shipping from Malaysia to Europe and your parts are rejected, basically you have to remanufacture and fly the output from Malaysia to Europe, and that's heavily costly. So MTech is now completely having a presence in every country, so that kind of risk for manufacturers is greatly mitigated. The other thing is that MTech has capability in now micro mechatronics, which is a field that is not easy to break into, and that complements its large form factor mechatronics. And so we see MTech's business has effectively transformed into a very comprehensive suite of capabilities, and its geographical spread is also quite wide now. We have a question on SodaStream. Hold on.
Hi, Ken here. Okay, question is, are you still positive on SodaStream since you studied it 2 weeks ago? Okay, the thing is, I am positive on SodaStream because my thesis is that soda making or soda machine sales and usage is not a fad. Since I covered it, there's been a recent NPD report that talks about that does market research on the soda machine making industry, and they reported in 2013 that there has been a 200% increase in consumable usage. Consumable usage essentially means carbon dioxide cylinders, etc., etc. So this shows that there's been a 200% increase in the US in terms of the continual usage of the soda machine. This soda machine is the industry itself, doesn't just mean SodaStream, but it does show that it is not a fad. Hence, based on this thesis that it's not a fad, okay, as I said, the fair price which I mentioned at $46 is just based on the thesis that it is not a fad. Okay. In order for the price to exceed $46, SodaStream still has got to show evidence that they can improve their gross margins, and so when they do, then you see a chance that price can exceed 46. But in the meantime, I think until they show evidence that they can improve their gross margins, right, 46 would probably be the fair price. I believe SodaStream. I believe SodaStream is trading for about $40 right now.
Okay, macro question. What is the impact of the interest rate increase in 6-month time? Will gold be a good buy? No, gold will not be a good buy. But let me just give you some background. Okay, the interest rate increase is 6 months after tapering has finished. Okay, so tapering will probably finish by the third quarter of this year, and then if you add 6 months to that, Janet Yellen's guidance looks to be around March 2015 when you have your first rate increase. Of course, this is all subject to economic data. Now, in such conditions, we have long held that stocks is going to be the best place to be. In an interest rate increase, bonds are going to be selling off, and so it's our view that despite the recent rally in bonds, it will resume its bear trend. And there's not much good reason to buy gold right now because you're actually tightening the money supply now. Okay, you're tapering and you're raising interest rates. So all that is probably positive for the dollar and going to be negative for gold. Okay, so pure yield strategy question. So stock picking, stocks targeting at least 5% yield returns. 3 companies that you can put your money into on ensuring capital preservation. Off the top of my head, I think Bowstead is a very good bet. In fact, my recent report, the headline was "Park Your Money Here." That was at 160 something. Now it's 190 something. So the yield, I think it's about 4 plus, right? Maybe 4 right now. So, however, that company has a lot of, is cheaply priced still. Okay, so when you X out the properties and you X out the cash on the balance sheet, then basically you're trading at 9 times, 7 times PE. And there's always earnings growth that can push the yield back to 5. Another one would be M1, actually. I'll let Colin share about M1.
Right. With regards to M1, we are very positive on M1, and that's mainly due to data monetizing, as more subscribers are actually exceeding their data allowances. Based on our target price, we believe there's quite a potential between a high single-digit upside in capital gain, and that's not including the dividend yield of about 4.2 to 4.3% rate. So we believe that M1 is a good bet, right, for the yield strategy and also for capital preservation.
Hi, so for the third pick, I would pick Penn United because the businesses are very resilient. As you can see, there's a long pipeline of infrastructure projects in Singapore, and of course the port in China is going to expand. It's in a duopoly situation, so margins will very likely be preserved. That's also about 4+% yield at the moment.
Hi, there's a question. I'm Lucas here. I'm covering the real estate side. So the question is, how will increase in interest rates affect REITs? The increase in, let's just look at it from a very pure numbers point of view. An increase in interest rate, okay, will ultimately affect how does the investment committee value the REITs. Okay, a higher interest rate will lead to a higher discount rate for their returns, and therefore the valuation of the REITs will actually come down. So an increase in interest rate actually negatively affect the REITs prices. Yep, I hope that answers your questions. But having said that, I think that the pending increase in this outlook that the interest rate will increase has been around for the past year or so, and a lot of the REITs has already adjust accordingly, and a lot of the potential increase in interest rate has already been priced into the REITs. So I do not think that there will be an overwhelming effect when it comes to the increase in interest rates on the current REIT prices. Yep. But to answer your question, it basically means that a high interest rate will will bring about a lower valuation of the REITs. Yep. All right. Hold on. Okay. I'm so sorry we do not have coverage over Midas right now. And yep, I think the time is up for today. If there's any question on Del Monte, do not hesitate to contact the analyst directly. And with that, I shall end today's session. Thank you.